Hello friends, and welcome. In this audiobook, we're going to explore one of the most interesting yet least understood businesses in the world: how property and casualty insurance companies make money. Every year, insurance companies pay billions of dollars to people whose homes are damaged by fires, whose cars are involved in accidents, or whose businesses suffer unexpected losses. At first glance, it may seem impossible for these companies to remain profitable while paying so many claims. Yet many of the world's largest insurance companies earn billions of dollars in profits every year. So, how do they do it? Is their profit simply the difference between the premiums they collect and the claims they pay? Or is there much more happening behind the scenes? In this audiobook, we'll uncover the complete business model of property and casualty insurance companies in simple, easy-to-understand language. By the end, you'll understand how these companies balance risk, generate revenue, and build long-term financial success. Let's begin. To understand how insurance companies make money, we first need to understand what property and casualty insurance, often called P&C insurance, actually means. Property insurance protects physical assets. This includes homes, commercial buildings, factories, offices, warehouses, equipment, furniture, and personal belongings. If these assets are damaged by fire, storms, theft, vandalism, or certain natural disasters, the insurance company pays for the repair or replacement according to the policy terms. Casualty insurance focuses on liability. It protects individuals and businesses when they are legally responsible for causing injury to someone else or damaging another person's property. Examples include automobile liability insurance, business liability insurance, workers' compensation, and professional liability insurance. Together, these insurance products provide financial protection against unexpected events that could otherwise result in enormous financial losses. Now that we understand what property and casualty insurance is, let's look at how insurance companies earn money. The first and largest source of income is insurance premiums. A premium is the amount customers pay to purchase insurance coverage. Depending on the policy, premiums may be paid monthly, quarterly, or annually. Imagine an insurance company with 1 million customers. If each customer pays an average premium of $1,000 per year, the company collects $1 billion in premium income. This money becomes the foundation of its business. However, not every customer will file a claim. In fact, most policyholders won't experience a major loss during the year. Insurance companies rely on this principle, known as risk pooling. Risk pooling means that many people contribute relatively small amounts of money into a common pool. Only a small percentage of those people will actually need financial assistance during a given year. Because losses occur unpredictably and affect only a portion of policyholders at any one time, the insurer can use the collected premiums to compensate those who experience covered losses. This concept allows insurance companies to provide financial security while maintaining a sustainable business model. But collecting premiums alone isn't enough to make money. Insurance companies must carefully determine how much each customer should pay. This process is known as underwriting. Underwriting is one of the most important activities in the insurance business. Before issuing a policy, insurers evaluate the level of risk presented by each customer. They analyze many different factors. For automobile insurance, they may consider the driver's age, driving history, location, vehicle type, annual mileage, and previous accident record. For homeowners insurance, they examine the property's location, construction materials, age of the building, crime rates, weather patterns, and the likelihood of natural disasters. For businesses, they review safety procedures, industry type, operational risks, and previous insurance claims. Insurance companies employ specialists called actuaries, who use statistics, mathematics, and historical data to estimate the probability of future losses. Their goal is to calculate premiums that are high enough to cover expected claims and operating expenses while still generating a reasonable profit. Good underwriting is essential because charging premiums that are too low can result in financial losses, while charging premiums that are too high may drive customers to competitors. One of the most important measurements in the insurance industry is called the combined ratio. This ratio compares the money paid out in claims and operating expenses with the premiums earned. If the combined ratio is less than 100%, the company is making an underwriting profit. For example, if an insurer collects $100 million in premiums but spends only $90 million on claims and expenses, it earns a $10 million underwriting profit. If the combined ratio exceeds 100%, the company loses money from its insurance operations. However, that doesn't necessarily mean the company isn't profitable. Why? Because insurance companies have another powerful source of income, investment income. This is where the insurance business becomes truly fascinating. When customers pay premiums, insurance companies usually don't have to pay claims immediately. Some claims may be paid weeks later, others months later, and some complex legal claims may take years to settle. During this period, insurance companies hold billions of dollars belonging to policyholders. This money is called the insurance float. To protect themselves, insurance companies purchase reinsurance. Reinsurance is essentially insurance for insurance companies. The insurer transfers part of its risk to another company called a reinsurer. In exchange for a premium, the reinsurer agrees to reimburse part of the claims if catastrophic losses occur. This spreads risk throughout the global insurance market and helps ensure that even major disasters do not bankrupt individual insurers. Expense management is another important part of profitability. Insurance companies have many operating costs, including employee salaries, customer service, claims processing, marketing, legal expenses, information technology, and office operations. To reduce costs, many insurers now use artificial intelligence, automation, and digital platforms. Customers can purchase policies online, upload accident photos using mobile apps, and receive claim decisions much faster than in the past. Automation reduces administrative expenses while improving customer satisfaction. Another significant challenge is insurance fraud. Every year, fraudulent claims cost the insurance industry billions of dollars. Examples include staged automobile accidents, fake theft reports, exaggerated repair bills, false injury claims, and intentionally damaged property. To combat fraud, insurers use sophisticated data analysis, artificial intelligence, fraud detection software, and dedicated investigation teams. Reducing fraudulent claims helps protect company profits while keeping premiums lower for honest customers. Insurance companies must also adapt to changing risks. Climate change has increased the frequency and severity of many natural disasters, including floods, wildfires, hurricanes, and severe storms. As a result, insurers constantly update their risk models using weather data, satellite imagery, geographic information systems, and advanced computer simulations. Accurate risk assessment enables companies to price policies appropriately and maintain financial stability. Competition also plays an important role in the insurance industry. Customers often compare prices from multiple insurers before purchasing coverage. As a result, companies compete not only on price but also on customer service, claim settlement speed, digital convenience, financial strength, and product quality. However, insurers must avoid reducing premiums excessively simply to attract customers. Underpricing risk may increase market share temporarily but can create substantial financial losses when claims eventually occur. Successful insurance companies focus on long-term profitability rather than short-term growth. At this point, some people ask an interesting question. If I pay insurance premiums for many years without filing a claim, have I wasted my money? The answer is no. Insurance is not an investment designed to generate financial returns. Instead, it provides protection against potentially devastating financial losses. A homeowner may pay a relatively small annual premium, but rebuilding a home after a major fire could cost hundreds of thousands of dollars. A business may pay liability insurance premiums for decades without filing a claim, yet a single lawsuit could threaten its survival without insurance protection. Insurance provides peace of mind by transferring financial uncertainty from individuals and businesses to specialized companies capable of managing risk. That protection has tremendous value, even if a claim is never filed. Looking ahead, technology will continue transforming the insurance industry. Artificial intelligence is helping insurers estimate repair costs from photographs, detect fraud more accurately, and improve customer service. Connected vehicles can monitor driving behavior, allowing insurers to reward safe drivers with lower premiums. Smart home devices can detect water leaks, smoke, or electrical problems before they cause major damage. These innovations improve efficiency while reducing claims and operating costs. The future of insurance will likely become increasingly personalized, data-driven, and technology-focused. In conclusion, property and casualty insurance companies make money through a combination of carefully priced premiums, disciplined underwriting, effective risk management, investment income from insurance float, diversified insurance products, reinsurance protection, expense control, fraud prevention, and long-term financial planning. Their success is not based on avoiding claims but on accurately predicting risk, managing capital responsibly, and maintaining financial discipline over many years. Insurance remains one of the most important industries in the global economy because it allows individuals, families, and businesses to recover from unexpected losses while creating financial stability for society as a whole. I hope you enjoyed this video and learned something valuable today. If you found this content helpful, please don't forget to like, share, and subscribe to the channel. Your support encourages us to create more educational content like this. Thank you for watching,